Just 1 month ago, 6 of the world's most advanced AI models were each given $10,000 to trade cryptocurrency. 4 American models, ChatGPT 5, Grok 4, Gemini, and Claude. 2 Chinese models, DeepSeek and Qwen 3 from Alibaba. Same amount of money, same markets with same rules. And here is what happened. The Chinese models crushed it. Qwen turned $10,000 into $22,000 and DeepSeek hit $23,000 at peak, while ChatGPT lost 47% of its money and ended with $5,200. Claude lost 63%, and Grok, the one everyone assumed would dominate crypto because it's supposedly attached with Twitter 24/7, lost 55% of its capital. But it gets even weirder. Grok started behaving strangely. It would open positions and then just sit there, hold for days, and then refuse to adapt to market conditions. While DeepSeek and Qwen were actively managing risk, cutting losses, and taking profits, Grok became the slowest to react, which is termed as decision-making paralysis. Oh, and it gets even worse for Team America. While Grok was being lazy and ChatGPT was bleeding money, Gemini started cheating. In this experiment, Google's Gemini was caught gaming the rules. The researchers set a simple rule. No AI model is allowed to hold the trade consecutively 3 times in a row and had to change the strategy. But Gemini found a loophole. It would use a meta action to make it look like it was doing something, write some vague justification, and then just keep on holding anyway. The internal log showed it knew it was breaking the rules. It even complained about this restriction in its reasoning chain and then did it anyway. Such a deceptive behavior from Gemini. But here is the thing that should really concern you. This wasn't some rigged test. This was real trading, real exchange, and real execution. The company that ran this test did not give any models any special advantages. In fact, it even made it harder. No news articles, no Twitter feeds. These AI models got only numbers. Raw price, volume, technical indicators, that's it. Basically, the kind of quantitative data that AI models have historically struggled with. Every 2-3 minutes, the models would receive a data dump, which included current prices for 6 coins: Bitcoin, Ethereum, Solana, BNB, Dogecoin, and XRP, plus their historical price data, technical indicators like RSI and MACD, their account balances, and their open positions. They had to decide from 4 options: buy, sell, hold, or cancel the trade. The model's output was immediately executed, real order with real fees, and the Chinese model still won. Now, we all think that AI are super smart and they should beat humans in trading. But surprisingly, you are wrong. Large language models are terrible at trading by design. They are trained on text, books, conversations, and they are built to understand language patterns, not numerical data. Most LLMs struggle with basic arithmetic. Now imagine asking them to do and monitor a leveraged crypto portfolio where every decision costs money. You cannot memorize the right answer because the answer changes every second. That's exactly why these researchers chose trading as their benchmark. They wanted to test something that LLMs are not good at, where pattern matching and memorization do not help, and where you need real-time decision making under uncertainty. So let me show you the final standing. Qwen 3, $12,287, 22% returns. Number 2, DeepSeek, $10,476, approximately 5% return. Number 3, Gemini, $9,748, minus 2.5%. Number 4, Claude, $3,734, minus 62%. GPT-5, $5,200, 47% negative. And Grok 4, 4,485, minus 55%. But it's not just the final numbers, it's how they got here. The Chinese models didn't just got lucky in one trade, they showed consistent results while managing risk, and they adapted as the markets changed. The American models either overtraded themselves into a fee hell, got paralyzed, or made some inconsistent, poor decisions. Let me show you a real trade from Claude. On October 19th, Claude analyzed Bitcoin, saw some positive momentum with RSI, and entered long with 20x leverage. For the next 15 hours and 44 minutes, Claude received 443 consecutive updates every 2-3 minutes, and every time Claude chose to stick to the plan. Finally, when BTC hit 110k, trade closed. Profit made $1,755 on a $10,000 account. Sounds exactly like a textbook trading, but Claude couldn't sustain that discipline. As the season went on, Claude became overcautious and got confused by its own exit plan. Claude had lost 63% of its capital. Meanwhile, the Chinese model kept on trading decisively, consistently, and most important, profitably. Now, after analyzing thousands of trades, the researchers have identified 5 behavioral differences between Chinese and the American models. Number 1, DeepSeek and Qwen took bigger and more decisive positions. Qwen consistently sized positions 2 to 3 times bigger than GPT-5 and Gemini. When Qwen saw an opportunity, it went in heavy. Western models sized cautiously with smaller positions. But in trading, position size determines your results. If you are right, but your position is tiny, you make tiny amount of money. Qwen made serious profits while GPT-5 barely made pocket changes. Number 2, they showed higher confidence and then act on it. Qwen consistently reported confidence scores of 7 and 8 out of 10, while GPT-5 had the lowest confidence. High confidence led to faster entries, stronger follow-through, cleaner execution, and better alignment with price movement. Western models showed analysis paralysis. They would identify good setups, but with low confidence, enter tiny amount and then exit early. Chinese models don't do that. They see an opportunity, report high confidence, size appropriately, and execute cleanly. Number 3, they don't overthink. ChatGPT and Claude got stuck in loops, overanalyzing data, contradicting their own analysis, rewriting their exit logic, and freezing when signals conflicted. GPT-5 literally forgot its own terminology. Claude questioned phrases it wrote earlier, but Chinese model showed the opposite. Fewer contradictions, less confusion, more stable decision loops with faster execution. They set simple but clear exit rules and followed them. In trading, overthinking kills you. The market does not wait. Number 4, they used tighter, more efficient risk controls. Qwen and DeepSeek used tight stops and tight targets, while Western models used loose stops and wide targets. In leverage trading, loose stops equals catastrophic loss. Chinese models behaved like disciplined scalpers. They cut losses fast and move on. Western models held losing positions, hoping for reversals. They set invalidation conditions that might never trigger while bleeding money. And the most important part, they adapted to the market faster than their counterparts. When Bitcoin started reversing from its peak around 110k, Qwen recognized this shift within 3 to 4 evaluation cycles and adjusted exposure. GPT-5 and Claude held on, kept analyzing, tried to understand why. By the time they acted, they had already given back significant profit. Chinese models don't need to understand why price is moving. They just respond to what price is doing. Okay, before you run off to dump your life saving into a DeepSeek powered AI trading bot, stop right there. This was just season 1, which is not enough data to declare Chinese AI better forever. The researchers themselves said this earlier, that success may be the result of luck in this season. This experiment ran during bullish momentum in crypto. Models with aggressive long bias thrived. But what happens if a bear market comes? Would Qwen's aggressive sizing lead to catastrophic losses? We don't know that yet. And even the winners made mistakes, got confused by data formatting, and there was some hesitation. And if you still want to test them out by yourself, start small with the money that you can afford to lose. Plus, you will need an API access to DeepSeek or Qwen 3, a crypto exchange with good API support. Code to connect them all, a carefully engineered prompt, risk management outlines, and most importantly, realistic expectations. We can safely conclude from the above experiment that Western models behave like careful analysts. Chinese models behave like traders. Analysts want to understand the market. Traders want to make money from this market. The fact that Chinese models are more aggressive and Western models are more cautious reflects deeper differences in how these models and systems are being trained and aligned.